The world of international trade has been a turbulent sea for years. The economic giants, the United States and China, have been locked in a contentious trade dispute. This dispute has sent ripples across the global economy. However, a recent development in May 2025 offered a glimmer of hope. In Geneva, negotiators from both nations hammered out a temporary truce. This agreement, though limited, was a significant moment. It signaled a potential pause in the escalating economic hostilities that have characterized their relationship. The global community watched with bated breath, hoping this could be a turning point towards more stable interactions. This truce is particularly significant given the prolonged period of tension. For years, tariffs and counter-tariffs have become the norm. Supply chains were disrupted, businesses faced uncertainty. Consumers often bore the brunt of these increased costs. The May 2025 agreement, therefore, is more than just a technical adjustment of tariff rates. It represents a crucial de-escalation. It offers a moment for both sides to step back from the brink. The hope is that this pause will allow for cooler heads to prevail and for more substantive negotiations to take place in a less charged atmosphere. The initial reactions to the truce were largely positive, albeit cautiously so. Financial markets, which abhor uncertainty, registered a sense of relief. There was an observable uptick in key indices as the news broke. Businesses, particularly those heavily reliant on trans-Pacific trade, expressed optimism. They hoped for a period of greater predictability in sourcing and sales. This mood shift, while welcome, was tempered by the understanding that the underlying issues driving the trade conflict were far from resolved. The truce was seen as a necessary first step, but not a final solution to the complex web of disagreements. However, it is crucial to remember the temporary nature of this accord. The agreement stipulates a 90-day period for the mutual reduction in tariffs. While this provides immediate relief, 90 days is a relatively short window in the grand scheme of international diplomacy and trade relations. The fundamental disagreements over trade practices, intellectual property, and market access remain deeply entrenched. The path forward will require sustained effort and a willingness from both Washington and Beijing to address these core issues. This truce is a fragile beginning, not a comprehensive end to the trade saga. The origins of this protracted trade conflict can be traced back several years. The Trump administration initiated the first major wave of tariffs in 2018. The stated rationale was to address what the U.S. considered unfair trade practices by China. These practices included alleged intellectual property theft and forced technology transfers. Washington also pointed to a significant trade imbalance. Large-scale tariffs were imposed on a wide array of Chinese imports. This move marked a sharp departure from decades of U.S. trade policy. It signaled a new, more confrontational approach towards China. The situation escalated rapidly from that point. China did not absorb these tariffs passively. Beijing responded with retaliatory tariffs on U.S. goods, targeting key American exports such as agricultural products. By 2019, the trade war was in full swing. Hundreds of billions of dollars worth of goods flowing between the two countries were affected by these new import taxes. This tit-for-tat escalation created significant economic uncertainty globally. International organizations warned of the potential damage to global growth and the disruption of established supply chains. The tension was palpable. In an attempt to de-escalate, the Phase 1 trade agreement was signed in January 2020. This agreement was heralded by some as a breakthrough. Under its terms, China committed to purchasing an additional $200 billion in U.S. goods and services over 2 years. It also included provisions related to intellectual property protection and financial services. However, the implementation of the Phase 1 deal proved challenging. Reports indicated that China fulfilled only a portion of its purchase commitments, around 58% according to some analyses. This shortfall became another point of contention between the two nations. The change in U.S. administration under President Biden did not immediately reverse the tariff policies. While the rhetoric shifted somewhat, many of the Trump-era tariffs remained in place. The Biden administration focused on a strategy of economic and technological decoupling in certain sensitive areas. This included enforcing export controls on critical technologies like semiconductors, artificial intelligence, and quantum computing. Tensions flared again in early 2025. The newly inaugurated Trump 2025 administration reportedly imposed a fresh 10% tariff on Chinese imports. This action significantly heightened tensions, setting the stage for the intense negotiations that led to the May 2025 truce. The specifics of the May 2025 truce, brokered in Geneva, involve a mutual, albeit temporary, reduction in tariff rates. For a 90-day period, U.S. tariffs on a range of Chinese imports were reduced by 115 percentage points, bringing the headline rate down to 30%. Concurrently, China agreed to lower its tariffs on U.S. goods to 10%. This reciprocal action was designed to ease immediate pressures and create a more conducive environment for further dialogue. The 90-day timeframe underscores the cautious nature of this agreement. It provides a window for assessment and further negotiation, rather than a permanent resolution. Despite these announced reductions, the reality on the ground is more complex. The effective U.S. tariff rate on Chinese goods remains stubbornly high. Due to various additional sectoral tariffs and pre-existing duties that were not covered by this specific truce, the overall burden on Chinese imports into the U.S. is still estimated to be around 40%. This means that while the truce offers some relief, a significant portion of the tariff wall constructed over the past few years remains intact. This limits the immediate economic stimulus that might otherwise have been expected from such a tariff rollback. Financial markets, ever sensitive to geopolitical shifts, reacted with a measure of cautious optimism. The news of the truce helped to soothe nerves frayed by months of escalating rhetoric and tariff threats. Concerns over further disruptions to global supply chains, which have been under strain for various reasons, eased slightly. There was a palpable sense of relief in business circles that the relentless cycle of tariff hikes might be paused. However, this relief was tinged with an awareness of the truce's short duration and the unresolved core issues. Questions about what happens after the 90 days immediately began to surface. One of the anticipated consequences of the reduced tariffs is an increase in U.S. imports from China. This could bring some benefits to American consumers, potentially leading to lower prices for certain goods. However, this surge in imports also carries potential downsides. It could lead to increased demand for shipping, potentially driving up freight costs. There are also concerns that a rapid influx of imports might exacerbate inflationary pressures, a delicate issue for many economies, including the U.S. The balance between consumer benefits and broader economic impacts will be closely watched. China, for its part, likely views the truce as a strategic win, perceiving that it has outmaneuvered the U.S. in this round. The 90-day pause established by the May 2025 truce primarily offers valuable breathing room. It effectively halts, at least for now, the cycle of escalating tariffs that has defined the U.S.-China trade relationship. This cessation of new hostilities is a positive development in itself. However, sources close to the negotiations suggest that further substantial tariff reductions beyond this initial period are considered unlikely in the immediate future. The focus, it seems, is more on preventing further deterioration than on a wholesale dismantling of existing trade barriers. This makes the next steps even more critical. Future negotiations will be absolutely crucial in determining the long-term trajectory of U.S.-China trade relations. It is widely expected that these talks will revisit the terms and implementation of the 2020 Phase 1 trade agreement. Many of the core issues that underpin that agreement, particularly China's commitments to purchase U.S. goods and address structural concerns, remain largely unresolved. The success or failure of these future discussions will depend on the willingness of both sides to engage constructively and find common ground on these persistent and complex sticking points. From a geopolitical perspective, China reportedly views this truce with a degree of strategic satisfaction. Some analysts within China and internationally suggest a perception in Beijing that it has successfully weathered the storm of U.S. pressure in this particular round of the trade conflict. This viewpoint, if widely held, could significantly influence China's negotiating posture in future discussions. Furthermore, the series of tariff escalations and subsequent partial rollbacks have led some observers to question the consistency and long-term credibility of U.S. trade policy, which could impact its relationships with other trading partners, including allies like the EU, with whom it had been coordinating. Ultimately, the path forward for U.S.-China trade relations remains fraught with uncertainty. The May 2025 truce is undeniably a welcome development, offering a much-needed pause from escalating tensions. Yet, the deep-seated economic rivalries and fundamental disagreements on trade practices and geopolitical influence persist. For a more stable and predictable global trade environment to emerge, sustained dialogue, a genuine commitment to addressing core concerns, and a willingness to compromise on both sides will be indispensable. The world will be watching closely to see if this fragile thaw can lead to a more enduring spring.